Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Just want to show you quickly, this is a chart that we did, and this is the U.S. dollar index. So I guess let me go back there real quick. So the point is, these are the $3 scenarios. Let me erase this. It's getting messy. Sorry. These are the $3 scenarios that we see based on some of the fundamental analysis and the alternative scenarios we set up. Consensus, second most likely or plausible, and this is kind of the least plausible scenario that we're watching that's very much in the background, and I'll explain that in a second. We put this chart together for an ISE webinar I did with Steve back in July 9th. And what's interesting on here, we showed the dollar. This is a weekly dollar, and this is how we use some of our technical analysis to validate some of the things we're doing. At the time, this shows a one. If you're familiar with Elliott wave, 1, 2, 3, 4, and 5 waves, we had, and we have been of the camp that the dollar, we're slowly losing faith in this camp, that the credit crunch was a game-changing event, and the dollar may have bottomed back in March of 2008 and may actually be in the beginning of a secular bull market. I know that is very much out of consensus, but it's part and parcel to a lot of the fundamentals that we did. But the point is, at the time we did this chart, we said that the critical support for the dollar is 74.31. At the time, the dollar was trading, I guess, around 78 or something at the time. Well, the dollar has come down, and again, on a technical basis, it's at 74.75. Again, still above what we call this. We had labeled as a 1 from an Elliott wave standpoint, which is considered critical support. So we're also at the stage in which we may get the kind of risk bid that we've been thinking about. This is a chart, and again, this is how we use just some of our longer term charts to kind of support, or at least give some validation or some probabilities to the fundamentals that we've created, or the fundamental ideas, alternatives we created. This chart shows the S&P 500, which is the red line, and the black line is the U.S. dollar index. And as you can see, these are pretty much mirror images of one another. As the dollar went up during the credit, during this period, the S&P, came down, S&P up, dollar down, dollar funding those risky asset classes, a fairly tight correlation. But what also we put on here, this is the MACD, or just an oscillator of overvaluation, undervaluation, and that's an overvaluation oscillator for the S&P. So we're just saying you want to be careful in here. And what's interesting is this whole idea of a risk event is starting to very much match up with our view that there's a big disconnect between the financial economy and the real economy, and the idea that we've seen some major valuations, and the idea that from a weekly technical basis, the dollar's in some really decent support area here. If it gets through, of course, if it gets through that support, which we talked about, back in here. And again, this isn't a technical story here, but if it gets through that support, 41.31 is key for us. It looks like it makes a new lower test. But again, those of you that do some technical analysis, this is how you can use some of your basic technicals to move in line with some of your fundamentals. They shouldn't be used, I think, in isolation. I think if you can bring some validity behind the technicals to your real-world economic view, I think you'll get more value out of the technicals as you go along. Vice versa, it supports and gives you more reality on your fundamental view. Ultimately, price action is what matters. No matter how confident we may be in an alternative scenario, and our confidence maybe that we're going to get some type of risk event and the dollar bounces in here, the reality is, if it comes through here, we have to stay with this trade. And the reality is, this is a powerful trend down in the U.S. dollar. So no matter how much we may think there's a risk event, there's no reason U.S. stocks can't continue to rally and the dollar continue down, down, down. That is the fact, and that is the consensus. And the number one scenario, the number one consensus supports this view. Major liquidity continue to be being pumped out by the U.S. government and the Fed, the world's de facto central bank. If that liquidity is being pumped out, there's no reason it can't continue to go into stocks, and there's no reason the dollar can't continue down. So that is the scenario we have to have in our head. But we have these valuation views on a technical basis, and we have our probable scenario setting up on the fundamental basis to say that the probability of that secondary view makes some sense. The consensus view, as I said, the U.S. government really has turned into the stimulator of last resort through the Fed monetizing and all types of things. As we know, the emerging markets really have led our way out of this morass so far, and they continue to be. U.S. dollar is a carry trade currency on low interest rates, which look like they're going to stay. Growth is anemic in the U.S., so foreign investments probably still continuing to drain out and look for better growth opportunities. The emerging markets are there. We've even seen stronger growth in Europe than we've seen in the U.S. So this scenario makes sense on a fundamental basis and a trend basis, so we have to assume it will continue to make sense. And if that makes sense, we continue to see the resumption of a long-term bear market in the U.S. dollar. Commodity currencies continue to rally. Euro continues to rally as the mirror image, and the emerging markets continue to rally also. The risk bid scenario, and I'm moving along here to give Steve some time, it's this idea of really a major rethink of what's going on, and it's that disconnect that I talked about between the financial economy and the real economy. What if we get some type of double-dip recession here? The U.S. consumer doesn't rebound. Well, that disconnect changes in a big way. Stocks crater, it's a risk event, and that money that moved offshore for all those great risky asset opportunities comes rushing back into the U.S. dollar because it moves into treasuries. Maybe there's some type of disappointment in China, whether economic, related to maybe some of the liquidity bubbles that have been building. Still a question whether there is liquidity bubbles. That's a whole other question, but they put a massive amount of stimulus in there, or maybe something on the social side. Emerging market crisis. We have, in terms of our best guess for potential emerging market crisis, it's Eastern Europe. You got Latvia, you got Ukraine, Hungary still in trouble. All the Baltics are just taking massive amount of pressure there. So, if we see some type of a crisis there, we usually get contagion in the emerging markets. It would very much roll into the euro and the euro banking system. A lot of money would flow out of the euro into the U.S. So that's a kind of a, again, we're watching very, very closely. And these scenarios, I think, all make some sense given the fundamentals, which means capitulation out of the emerging markets, money flowing back, a lot of hot money flowing back out of China and the European banking system. What's it do? It hides again in the U.S. Treasuries. Doesn't come back to the dollar because it likes the dollar. It goes in here because of the depth of the capital markets. And as I said, if there's a major risk event this time and they have to come back and hide, they're going to come out very, very slowly. And relatively, the rest of the world will tend to look, in terms of where the U.S. is, all of a sudden look a lot worse than it did prior to the risk event, which means money, I think, would stay into the U.S. dollar. So this idea of a risk event is just not a one-off type thing. It could be a longer-term event out there. Dollar rallies, as I said. What gets hammered the hardest on a risk event is this commodity currencies that have moved up fastest. Euro tanks, especially if the problems roll out of Europe, of Central Europe. The yen, we continue to open question mark on the yen. It's rallying here on repatriation, very much against our expectations and position. Money's moving back in Japan in and of itself on risk. It's very much a wild card because the Japanese economy is in terrible shape longer term.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.